SpaceX just launched more than cargo to the International Space Station. It launched a new business case for staying in orbit. The Dragon on CRS-33 carries a propulsion system that can boost the station's orbit. The Falcon 9 first stage underneath it is flying for the 7th time. That combination turns one resupply mission into an investor question. Is SpaceX still just selling launches, or is it becoming the operating layer for orbital infrastructure? The market usually prices a launch as a single event: liftoff, deployment, landing, done. The more interesting value is what the mission makes possible after the rocket disappears from view. CRS-33 is carrying more than 5,000 pounds of science, supplies, and station hardware, according to Spaceflight Now's launch log. The new trunk-mounted propulsion system is designed to raise the International Space Station's orbit. It also sits on the critical path for the eventual ISS deorbit vehicle, which NASA and SpaceX will need as the station approaches the end of its functional life around 2030 or 2031. For investors, the implication is not that one mission suddenly changes fair value. It is that launch cadence, spacecraft design, government relationships, and orbital logistics can compound into a much larger platform. Start with the physical mission. CRS-33 launched from Space Launch Complex 40 at Cape Canaveral. Falcon 9 sent Cargo Dragon toward the station. Then the booster returned to a drone ship a little more than 8 minutes later. The booster was B-1090, flying for a 7th time. That 7th flight matters because reusability is not a slogan, it is an operating metric. Every additional flight tests inspection, refurbishment, schedule discipline, and the ability to spread hardware cost across more missions. The Cargo Dragon is the other half of the story. Its unpressurized trunk carries the new propulsion system. That system can perform an orbit boost for the station, extending the range of jobs a resupply spacecraft can perform after delivering its payload. This is a subtle but important shift. The launch vehicle moves mass. The spacecraft can now help manage the orbit where that mass operates. The long-term customer is not just a commercial satellite operator, it is NASA and potentially the broader government market for resilient orbital logistics. Space station orbit maintenance sounds unglamorous. That is precisely why it matters. Infrastructure businesses often win by owning the jobs nobody wants to improvise at the last minute. The timing also fits a broader SpaceX operating pattern. In August, the company has continued to fly Falcon 9 missions at a pace that makes a single successful launch less of a spectacle and more of a production unit. Spaceflight Now reported SpaceX's 100th orbital mission of 2026 on August 22 alongside another successful booster landing. That is the difference between a launch company and a launch network. One sells an event, the other sells availability. Now connect the mission to SPCX, the public market vehicle investors are using to express a SpaceX view. A TradingView capture from August 24 showed SPCX at 136.97 on the prior August 21 update. That is far below the roughly $225 peak and only slightly above the $135 IPO debut in the local reference baseline. The first trade is simple. Separate operating durability from short-term price movement. A chart can fall while the company keeps launching, adding subscribers, and building infrastructure. A strong mission does not guarantee a cheap stock.
It does give investors another piece of evidence about the business model. MarketBeat's SPCX page displayed a moderate buy consensus and an average price target of $220.20 from 41 analysts. Treat that as a sentiment snapshot, not a forecast carved in stone. The spread between a displayed $75 low target and an $800 high target is a reminder that the valuation debate is enormous. The bullish case is not just SpaceX launches a lot. It is a layered revenue stack. Starlink can monetize connectivity. Falcon can monetize access to orbit. Dragon can monetize transport and station logistics. Future systems can monetize government data, orbital servicing, and the physical infrastructure needed around the ISS transition. That stack creates operating leverage. Reusable boosters lower friction. A repeat customer such as NASA creates demand visibility. A spacecraft that does more than carry cargo can create a larger contract surface around each mission. But the public market trade is not isolated. When SPCX attracts attention, capital can rotate away from smaller space names, even when their operating stories remain intact. Rocket Lab, ASTS Space Mobile, Intuitive Machines, Iridium, and Firefly can move on flows, not only on mission results. That is why a SpaceX episode belongs on a space stock channel. SPCX is both a company and a sector gravity well. Its scale can validate the category while competing for the dollars that smaller companies need. The investor's job is to ask what part of the stack the price already assumes. Is the market paying for today's launch cadence? For Starlink growth? For future station and deorbit infrastructure? Or for all of it at once? That framing also keeps the smaller names in view. Rocket Lab can benefit from government demand without becoming SpaceX. AST Space Mobile can build a direct-to-device network without owning a launch system. Intuitive Machines can win lunar work without competing for every broadband dollar. The question is not which company tells the best story, it is which cash flows are becoming more repeatable and which valuation already assumes a perfect launch calendar. The highest quality signal from CRS-33 is therefore operational, not promotional. A system that can fly, deliver, boost, and return on schedule earns the right to be evaluated as infrastructure. It still has to earn the right to be evaluated as a high-margin infrastructure business. Risk 1 is valuation. A $135 IPO, a roughly $225 peak, and a displayed $136.97 prior session mark describe volatility, not intrinsic value. A price can be lower because expectations reset, not because the business broke. Risk 2 is concentration. The SpaceX story remains tightly associated with one founder, one integrated operating system, and a few very large bets. A delay in Starship, a launch anomaly, regulatory friction, or a change in capital needs can hit sentiment across the whole complex. Risk 3 is that a successful resupply flight is not the same thing as a fully commercialized orbital infrastructure business. The propulsion package proves capability. It does not prove the final economics of station reboost, deorbit services, or future government contracts. Risk 4 is competitive and regulatory. NASA's relationship is valuable, but government procurement can be slow. Other launch providers can improve. Satellite to phone, broadband, and orbital servicing markets can require more capital before they produce durable margins.
The clean read is disciplined watch mission cadence, successful reusability, Starlink economics, NASA contract conversion, and cash needs. Do not turn a launch result into a price target. There is also an information risk. Public investors can see the rocket launch, but not every contract margin, customer commitment, satellite failure rate, or refurbishment cost. A spectacular image is easy to verify. The unit economics are slower and harder. That gap is where the strongest narratives can outrun the strongest evidence. The bigger question is whether orbit becomes a managed utility. If it does, the winners will not only be the companies that reach space, they will be the companies that can deliver, repair, reposition, connect, and eventually retire the hardware already there. CRS-33 is a small but visible step in that direction. A cargo Dragon performs a delivery job, then helps with the station's orbit. The same company operates the launch vehicle, the spacecraft, the network, and the ground infrastructure around them. For SPX investors, that integration can be a moat. For small-cap investors, it is a warning not to confuse category growth with automatic stock upside. The capital can flow to the scaled platform even while smaller names build the components, services, or alternative paths. My base case is not a prediction of a straight line higher. It is that repeated execution keeps expanding the set of businesses the market is willing to attach to SPX. The trade is then about price paid for that durability and how much future infrastructure is already in the multiple. So here's the question for the comments.